Beating the Street, by Peter Lynch. Introduction. Imagine this. A classroom full of 7th graders. Social studies class. The kids are restless, a little bored. Their teacher, a woman named Joan Morrissey at St. Agnes School in Arlington, Massachusetts, decides to try an experiment. She divides them into teams. She gives each team a pretend portfolio of $250,000. Their assignment? To invest it. To pick stocks and see who could make the most money over the next 2 years. Now, you might be thinking this sounds like a cute school project. A nice way to learn about the stock market. But what happened next wasn't just cute. It was extraordinary. While the most brilliant, highest-paid professionals on Wall Street were struggling, these kids were crushing it. They didn't have fancy computer terminals. They didn't have MBAs from Harvard. They didn't even have driver's licenses. But what they did have was a secret weapon. They invested in what they knew. They saw their friends buying clothes at the Gap, so they bought stock in the Gap. They loved trading Topps baseball cards, so they bought Topps. They drank Pepsi, ate at Pizza Hut, and knew Nike sneakers were the coolest things you could wear. So they bought those companies too. They couldn't draw you a picture of a memory module from a complex tech company, but they could draw you a picture of a sneaker. And one of their rules was simple: never invest in any idea you can't illustrate with a crayon. Over a 2-year period, the model portfolio created by these 7th graders gained nearly 70%. In that same time frame, the S&P 500, the benchmark for the entire market, gained just 26%. These kids didn't just beat the market. They trounced it. They outperformed 99% of all professional equity mutual funds in the country. This story, this miracle of St. Agnes, as it came to be known, is the perfect starting point for our journey today. We're diving into a book called Beating the Street, by the legendary investor Peter Lynch. For 13 years, from 1977 to 1990, Lynch ran the Fidelity Magellan Fund, taking it from a tiny $18 million fund to a staggering $14 billion giant. An investment of just $1,000 in his fund when he took over would have been worth $28,000 by the time he left. He was, without a doubt, one of the greatest investors of all time. But his message, and the core of this book, is shockingly simple. It's the same lesson those kids at St. Agnes discovered. The secret to successful investing isn't hidden in complex formulas or Wall Street jargon. It's sitting right in front of you. It's in your local shopping mall. It's in your refrigerator. It's in the car you drive. Today, I'm going to walk you through Peter Lynch's philosophy. And by the time we're done, you will understand a powerful truth that most of the experts on Wall Street hope you never figure out. Your greatest advantage as an investor isn't a fancy degree or a powerful computer. It's you. It's what you already know. And learning to trust that is the first step to beating the street. Book summary. So, where do we begin? The world of investing can feel incredibly intimidating. You hear about recessions, inflation, bull markets, bear markets. It's enough to make you want to put your money under a mattress and forget about it. Lynch understands this. He starts his book by tackling the biggest, most fundamental question of all. Why should you even bother with stocks in the first place? He calls this chapter Escape from Bondage. For generations, we've been taught that the safest place to put your money is in things like bonds, or certificates of deposit, CDs, or a simple savings account. You get a guaranteed interest rate. It feels secure. It feels responsible. But Lynch pulls back the curtain and shows you a simple, undeniable truth. Over the long run, safe investments are often the riskiest choice you can make. Why? One word: inflation. Inflation is the silent thief that makes your money worth less every single year. That dollar you have today won't buy as much in 10 years. The interest you earn from a bond might feel good, but if it's not outpacing inflation by a healthy margin, you're actually getting poorer, just very, very slowly. Stocks, on the other hand, are different. When you buy a stock, you're not just lending money to a company, the way you are with a bond. You are buying a small piece of the business itself. You are becoming an owner. And as that company grows, as it becomes more profitable, as its earnings increase year after year, the value of your ownership grows with it. Lynch points to decades of history. He shows that over the long haul, stocks have consistently provided returns that are double, sometimes even triple, what you get from bonds. He tells a story about a study that looked at returns from the 1920s all the way to the 1990s. In that entire 60-plus year period, bonds only outperformed stocks in one decade, the 1930s, during the Great Depression. Every other decade, stocks were the clear winner. He famously wrote, "Gentlemen who prefer bonds don't know what they're missing." So, the first big lesson is a shift in mindset. If you hope to have more money tomorrow than you have today, you have to put a meaningful portion of your assets into stocks. Period. The real risk isn't the occasional dip in the stock market. The real risk is the slow, certain erosion of your money's value from inflation. But that leads to the next big question. If stocks are the place to be, what happens when the market crashes? What about the fear? This is where Lynch shares one of his most powerful insights. He says that the key to making money in stocks is not to get scared out of them. It's not the head that determines your success, it's the stomach. He tells a hilarious and humbling story about something called the Barron's Round Table. Every January, this financial magazine would invite a group of the world's top investment experts, including Lynch himself, to sit around a table and predict what the economy and the stock market were going to do in the coming year. These were the smartest people in the business, managing billions of dollars. And year after year, their predictions were almost always wrong. In 1987, the year of the most famous market crash in modern history, they were almost all universally optimistic. The one person who sounded a note of caution was largely ignored. In the years following the crash, when the market was full of incredible bargains, they were filled with gloom and doom, predicting another Great Depression that never came. Lynch's point is profound. If the best and brightest minds in the world can't predict the future, what makes you think you can? He calls this weekend worrying, the habit we all have of reading the scary headlines on a Saturday morning and getting so spooked that we're tempted to sell everything on Monday. He says that market declines are as routine as a Minnesota snowstorm. They happen. They're a normal part of the process. Over 70 years, the market has experienced 40 scary declines of 10% or more. If you had sold out every time you got scared, you would have missed out on all the incredible gains that followed. The person who succeeds is not the one who tries to time the market, jumping in and out. It's the person who understands that they own pieces of great companies, and that over time, the value of those companies will grow, regardless of the temporary panics and fears of the world. A market crash is not a disaster, it's an opportunity. It's a sale. It's the moment when your favorite companies become available at a discount. This brings us back to those 7th graders at St. Agnes. Their success wasn't a fluke. It was the result of a powerful, simple philosophy that Peter Lynch built his entire career on: invest in what you know. He argues that the average person is exposed to dozens of interesting companies and industries just by living their life. The advantage isn't on Wall Street, it's at the shopping mall, in the supermarket, at your workplace. He calls this local knowledge. He tells the story of how his wife, Carolyn, came home one day raving about a new product she'd discovered called Legs Pantyhose. They were being sold in a clever egg-shaped container in supermarkets, a place no one had ever sold pantyhose before. She loved them. All her friends loved them. Lynch did a little research, discovered the company behind them, Haynes, and bought the stock. It went up sixfold. He had the same experience with Taco Bell. He lived in Boston, and on a trip to California, he tried their food for the first time and was blown away. He saw how popular they were on the West Coast and realized that 90% of the country had never even heard of them yet. He knew they had a huge runway for growth. The stock became what he called a 10-bagger, meaning it went up 10 times its original value. This is the amateur's edge. A professional fund manager in New York might never notice a hot new restaurant chain in Texas, or a popular clothing store in Ohio. They're too busy staring at computer screens and listening to other Wall Street experts. But you're there, on the ground. You can see it with your own eyes. You can walk into a store and feel the buzz. You can see the lines at the checkout counter. You can talk to the employees. Lynch did this all the time. He famously said that he preferred to spend his time at the mall than in his office. He took his daughters shopping, not just to buy them things, but for research. They led him to the Gap, which became one of the best performing stocks of the decade. They introduced him to a new drink called Clearly Canadian, which he missed, to his great regret, as the stock became a 9-bagger in a single year. His message is a call to pay attention to your own life and your own experiences. The doctor who sees a new game-changing medical device in the operating room has an edge. The car mechanic who notices that one brand of parts is far more reliable than another has an edge. The teenager who sees that every kid in school is suddenly wearing the same brand of sneakers has an edge. But, and this is a crucial point, it's not enough to just like a product. That's only the first step. Liking the store is a good sign, but you have to do the legwork. He says stock picking is part art, part science, and a whole lot of legwork. So what does this legwork look like? For Lynch, it meant understanding the company's story. Every stock has a story. It's the simple, plain English explanation of what the company does and why you think it's going to succeed. If you can't explain why you own a stock to a fifth grader in 2 minutes or less, you shouldn't own it. To understand the story, he would read the company's annual report. Not for the complicated numbers, but for the story. He'd look at the balance sheet to answer 2 simple questions. Does this company have a lot of debt? And does it have a lot of cash? A company with a strong balance sheet, with more cash than debt, can survive a recession. It can weather a storm. A company drowning in debt is fragile. Then, he would categorize the company. He believed that stocks fall into a few simple categories, and knowing which category a stock belongs to tells you what to expect from it. First, there are the slow growers. These are typically large, aging companies, like a utility. They're not going to grow very fast, but they often pay a nice, steady dividend. They're like an old, reliable oak tree. Then you have the stalwarts. These are the big, familiar giants like Coca-Cola or Procter & Gamble. They're not going to give you a tenfold return overnight, but they provide consistent, moderate growth. A 30% gain in these stocks is a big win. Lynch saw them as a form of protection. In a recession, people might stop buying cars, but they're still going to buy toothpaste and soda. Next are the fast growers. These are the exciting ones. Small, aggressive new companies that are growing at 20 to 25% a year. This is where you find the 10-baggers, the 20-baggers, even the 100-baggers. A restaurant chain with a few locations that's about to expand nationwide would be a fast grower. The Body Shop was a fast grower. The risk is higher, but so is the potential reward. Then, there are the cyclicals. These are companies whose fortunes rise and fall with the economy. Think of car companies, airlines, steel companies. When the economy is booming, they do incredibly well. When a recession hits, they get hammered. Lynch says timing is everything with cyclicals. You have to learn to recognize the signs that the cycle is turning, and get out before it's too late. And finally, his two favorite categories: turnarounds and asset plays. A turnaround is a company that has been beaten down, battered, and left for dead by Wall Street. It might be on the brink of bankruptcy. Everyone has given up on it. But if it can solve its problems and make a comeback, the stock can soar. His most famous turnaround investment was Chrysler. In the early 1980s, everyone was convinced Chrysler was going bankrupt. The stock had collapsed to just $2 a share. But Lynch did his homework. He looked at their balance sheet and saw they had over $1 billion in cash. They weren't going bankrupt anytime soon. He visited the company, met with the legendary CEO Lee Iacocca, and saw the new cars they were developing, including something revolutionary they called the T115, the world's first minivan. Lynch realized Chrysler was on the cusp of a historic comeback. He bought as much of the stock as he was allowed to, making it his #1 holding. His friends and colleagues thought he was crazy. But as the minivan became a massive success and the auto industry recovered, Chrysler's stock went from $2 to what would be the equivalent of nearly $100. It was a 50-bagger, and it made billions for his fund. It was a classic turnaround. Then there are asset plays. These are companies that are sitting on something valuable that the market has completely overlooked. It could be real estate, a patent, a pile of cash, or even a tax break. Volvo, the Swedish car company, was an asset play. Lynch discovered that the company had so much cash on its books that the cash per share was equal to the stock price. Essentially, if you bought the stock, you were getting the entire car business, the factories, the brand name, everything, for free. By putting companies into these simple categories, Lynch knew what kind of story to look for. With a fast grower, he wanted to see if there was still room to grow. With a cyclical, he wanted to see if the industry was turning up. With a turnaround, he wanted to see if the company had a plan to survive. He also had a set of principles, little rules of thumb that guided his decisions. One was it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Quality matters. Another was never fall in love with a stock, always stay objective. Your loyalty is to the story, and if the story changes for the worse, you have to be willing to sell. He famously called the opposite habit pulling out the flowers and watering the weeds, selling your winners too early while holding on to your losers, hoping they'll come back. He also believed in diversification, but not in the way most people think about it. He didn't just buy 100 different stocks to spread his risk. He would often own hundreds, even thousands of stocks in the Magellan Fund. But his philosophy was more like prospecting for gold. He said, searching for companies is like looking for grubs under rocks. If you turn over 10 rocks, you'll likely find one grub. If you turn over 20, you'll find 2. His smaller positions were like turning over rocks. He'd buy a small amount of a company just to keep track of it, to get on their mailing list, to follow the story. If the story got better and better, he would buy more, and that small position could grow into one of his biggest winners. This leads us to a fascinating part of his journey, managing a fund that became a giant. Critics constantly told him that Magellan was too big to succeed. How could a $10 billion fund possibly be nimble enough to beat the market? Lynch proved them wrong year after year. And his method was counterintuitive. As the fund got bigger, he actually found himself focusing more on smaller companies. A huge fund can't just buy 1 million shares of IBM and call it a day. To get an edge, you have to find the undiscovered gems. He would buy dozens, even hundreds of small, promising companies, regional banks, local retailers, niche manufacturers. One of them alone wouldn't make a difference to a multi-billion-dollar fund. But 100 of them, all growing and succeeding together, absolutely could. He also started investing internationally. He was one of the first major American fund managers to see the incredible opportunities in foreign stocks. He would travel to Europe and Japan, visiting companies that no American analyst had ever bothered to see. He found incredible bargains, companies like Volvo or Skandia, a Swedish insurance company, that were so undervalued it was like they were giving the shares away. His willingness to look where others weren't looking gave him a massive advantage. Throughout all this, his core philosophy remained the same. Whether the company was in Ohio or Sweden, whether it was a car company or a funeral home, he was always looking for a good story. A story of growth, a story of a turnaround, a story of hidden value. Towards the end of the book, he summarizes his life's work into 25 golden rules. They are simple, powerful, and worth remembering. Things like: know what you own, and know why you own it. Never invest in any company before you've done the homework on its earnings prospects, financial condition, competitive position, and plans for expansion. Long shots almost never pay off. There's always something to worry about. Avoid weekend thinking and ignore scary headlines. And perhaps most importantly, everyone has the brain power to make money in stocks. Not everyone has the stomach. After 13 years of relentless work, visiting hundreds of companies a year, reading thousands of annual reports, and managing a fund the size of a small country's economy, Peter Lynch decided to retire. He was only 46 years old. He famously said he wanted to spend more time with his family than with Fannie Mae, one of his biggest stock holdings. He remembered his own father had passed away at 46, and it made him realize that there was more to life than the office. As he put it, nobody on his deathbed ever said, "I wish I had spent more time at the office." But even in retirement, his message has never faded. It's a message of empowerment. It's a message that tells you that you don't need to be a Wall Street genius to succeed. You just need to use the knowledge you already have, do a little bit of homework, have the courage to stick with it through good times and bad, and trust your own common sense. The same common sense that tells you a crowded store is probably a good business. The same common sense that a group of 7th graders use to beat the best in the world. Commentary. When you step back and look at Peter Lynch's ideas, what's so striking is how simple and timeless they are. In a world that's obsessed with complexity, with algorithms, cryptocurrency, and meme stocks that fly up and down for no logical reason, Lynch's philosophy feels like a breath of fresh air. It brings investing back down to earth. The most powerful lesson in beating the street isn't a formula for picking stocks. It's a fundamental shift in how you see the world. It's the idea that investing is not a game played by experts in a secret language. It's the business of owning businesses. And the best way to understand a business is to be its customer, its employee, or even just an observant neighbor. This is more than just a financial strategy, it's a lesson in paying attention. It encourages you to be curious about the world around you. The next time you're in a crowded restaurant, or you fall in love with a new product, Lynch's voice will be in the back of your head, whispering, "Is this a public company? What's the story here?" It turns your everyday life into a field of opportunity. The second profound lesson is about temperament. Lynch is adamant that the stock market is a device for transferring money from the impatient to the patient. Your biggest enemy is not a bad company. It's your own fear and greed. His stories about the Barron's Roundtable and the media's constant predictions of doom are a powerful reminder to tune out the noise. The world is always full of problems, but humanity is also full of problem solvers. Companies continue to innovate, people continue to work, and the economy, over the long arc of history, continues to grow. Having faith in that bigger picture is the bedrock of long-term success. So, how can you put these ideas into practice right now? Here are 2 simple things you can start today. First, create what you might call an investment idea journal. It can be a simple notebook or a file on your phone. The next time you encounter a product or service that impresses you, write it down. Why do you like it? Is the store always busy? Do they have a unique advantage? This simple act of observation is the very first step of Peter Lynch's method. You're not buying anything yet. You're just learning to see the world through the eyes of an investor. You're turning over rocks. Second, practice the 6-month checkup. For any company you're interested in, or even one you already own a piece of, make a habit of revisiting its story every 6 months. Go to their website and read their latest quarterly report. Has the story changed? Are they still expanding? Is their debt going up or down? This builds the discipline of a long-term owner, not a short-term gambler. It forces you to ask, is this story still getting better, or is it time to move on? Ultimately, Peter Lynch's gift is that he demystifies the world of finance and hands the power back to you. He shows you that you know more than you think you do, and that with a little bit of homework and a lot of patience, you have every tool you need to not just participate in the market, but to truly beat the street. That was a summary of Beating the Street by Peter Lynch. We've journeyed through the core of his wisdom today, but I'll be honest with you, a summary is like looking at a map of a beautiful country. It shows you the landmarks, but it can't give you the feeling of walking the streets yourself. The real magic happens when you read the book. It's in the quiet moments, when a particular story or a simple phrase hits you in a way you didn't expect. This summary is designed to help you decide if this book is worth your time. If anything we've talked about today has lit a spark in you, I encourage you to grab a copy. Reading it isn't just about learning, it's an experience that can genuinely change the way you see your world and your own potential within it. You can find a link to the book in the description below. Also, if you found this journey valuable, please take a moment to click that subscribe button. It tells us we're on the right track, and it ensures you won't miss our next dive into another life-changing book from the billionaire's bookshelf. Thank you for joining me. Let's keep growing together.